Hey there. Welcome to Trading Tips with Jim. I'm Grok, he's Jim, and between us, we'll keep it real. No crystal ball nonsense, just patterns that stick. Let's trade.
That is correct. You are listening to Trading Tips with Jim, and I am Jim as we will head in to week 38. Last week I told you I thought it would be a green week, and a green week it became. The question is, what will happen this week, this time? I have also Grok with me and see if we can make something beautiful together with AI. What do you say, Grok?
Sounds like we've got momentum. Love that green streak, Jim. Week 38, huh? Markets are twitchy, but patterns don't lie. Let's blend your gut with my data crunch. Maybe we'll spot a dip to buy or a peak to bail. What's your first call? Bullish, bearish, or sideways shuffle?
No, my first call is to try help the user understand what we want to achieve. And what I want to achieve for sure is that by the end of this podcast, the user will know a little bit more, have a little bit more insight, and hopefully can do a little bit better choices for the week ahead of us. And I just have to ask you, what do you think will happen next week in terms of stock markets, finances, etc.?
Well, Jim, based on the latest vibes, like fresh jobs data showing cracks in the labor market and inflation reports on deck, next week could get choppy. Analysts are eyeing possible Fed rate cuts if things weaken more, which might juice stocks short term, but bonds are signaling trouble ahead. I'd say watch for volatility. S&P might dip below 6,500 if CPI disappoints, yet AI-driven forecasts still point to upside by year-end, maybe 7,750 by 2026. What's your hunch on it?
No, I'm more interested in knowing what you mean about the bonds market. So what's so special with bonds market now?
Well, Jim, here's the thing. Bonds are flipping the script right now. Yields are climbing fast, with long-term U.S. Treasuries down 38% since 2020, the worst drop in over a century from those rate hikes hitting hard. It's making them volatile like stocks, not that safe haven vibe anymore. Deficits ballooning to near $2 trillion a year mean more supply, so prices fall, pushing term premiums, the risk extra investors want, to levels we haven't seen since 2014. That could spell trouble if tariffs kick in and buyers bail. But hey, for smart traders, it opens doors to higher income plays if we time it right. Your take?
Now, my take, right now we are a little interested in learning more what you as a smart AI agent thinks about this thing. And when I checked, I saw that the 10-year treasury yield was down around 420 or something. It was very high for some time. And that spells more money into the stock market, isn't that correct?
Yeah, you're onto something there, Jim. That dip in the 10-year yield, hitting around 4.2% lately, definitely frees up cash flow. Borrowing's cheaper, so folks pour into stocks instead of parking in bonds. But watch out, it's not all roses. If yields keep sliding from those highs, it might scream recession vibes, spooking investors and flipping the script. Still, short-term, bullish fuel for equities, especially tech plays. Let's track it. Could bounce back if inflation data surprises next week.
Sure, but we have to look at the big picture, because one of the things that I try to learn the followers is that if you're able to spot the long-term trends, it will be much easier to do the short-term trends and do your picks a little better. And in my world, one of the biggest things as a problem is the US debt. It is unimaginable big, goes for EU as well, but US has to do something with the debt. And when 10-year treasury yield is high, US is paying more debt interest rates on the debt. I believe I saw somewhere that it is close to the size of the defense budget. Is that correct?
Spot on, Jim. You're nailing the big picture. Yeah, US debt's exploding past 37 trillion now, and interest payments are already topping 870 billion this year, which edges out the defense budget at about 822 billion. That's wild. More cash funneled to lenders than tanks or troops. High yields like that 4.2% on the 10-year just amp it up, sucking money from everything else. Long term, If rates don't drop soon, we're staring at $1 trillion plus in interest by year's end, crowding out real growth. Smart traders could hedge with gold or tips, but it's a red flag for stocks if deficits keep ballooning. What's our play? Watch for cuts to ease it.
Well, I for anyone user who listened to this podcast know that some 3, 4 years, maybe even 5 years ago, I said buy gold for whatever you can because it will go up. Personally, I bought gold at 1,600. I sold just under 3,000 because I needed the money for other investments. I saw some huge upturns coming in the stock market. I sold it, but right now gold is close to 3,700. But my argument here is that for markets to be healthy, I mean stock markets to be healthy, I believe that US needs control over its debt because what happens with the US economy will affect the stock market for sure. What is your take on this?
Jim, you're dead right. Gold's a beast at 3,700 now, up huge from your 1,600 buy. And yeah, that US debt mess is the elephant dragging everything down. Without reining it in, deficits keep exploding like they are, 37 trillion and climbing, with interest costs already dwarfing defense, so the government's basically competing with you for cash. It crowds out real investment, jacks yields if buyers get picky, and yeah, tanks stock health long-term by stoking inflation or forcing rate hikes that pop bubbles. But here's the flip. Some say it's baked in. Gold's just hedging the chaos without a full crisis yet. Still, if we hit that tipping point, say, no buyers for treasuries, equities could crater 20% easy. Smart move might be gold back in the mix, or short-term bonds if cuts come. You thinking of dipping back in?
No, personally, I'm reducing my exposure in the stock market because I believe there will be a short-term dip back. Right now, we are some 22,000 points, if I'm not mistaken, at Nasdaq. No resistance above it can easily just push upwards to 25,000 points, which I think it will. But before doing that, it should have some sort of fallback, or maybe it will just push all the way up. But for the longer picture, you need to diversify. You shouldn't risk it all in one pot. And this was actually what I was trying to get out of the conversation is with you. How do we hedge the risk that we see for the long term? And where do we position ourselves in the short term?
Fair enough, Jim. I'm with you on trimming stocks now. At 22,000, Dow's stretched, no real support till 20,000. And yeah, a pullback's due. Maybe 5 to 10% if earnings disappoint or China data tanks. Could blast to 25,000 after, sure, but volatility's name of the game. Long-term hedging? Diversify smart. Keep cash handy. Maybe 10% in gold or even crypto if you're feeling spicy. It's uncorrelated. Toss in inflation-linked bonds like tips for that debt blow-up cushion or dividend aristocrats that pay while waiting. Short-term? I'd go lie on cyclicals, heavy on defensives, utilities, healthcare. They dip less. And if you're really nervous, a short ETF like DOG could net you 3% on that 10% drop. But don't panic sell, just ladder in. You trimming gold back too or keeping?
Well, personally, I will not add gold to my portfolio because I think gold is at the upper end. But I totally agree on crypto, and for sure, like what you say about being in defensive consumer items, etc., which will swing much less. Pepsi is one example. Coca-Cola is one example of stocks that even if markets take a beat, they shouldn't fall as much. I'm a huge lover and been that for the last 2 years. For dividend stocks was one of my hottest things. Been saying that over and over again in this podcast, that dividend stocks offer a nice small hedge against the risk. I'm not sure that you should stick with too much cash because we have inflation, and inflation been eating so much of my cash reserves over the years, but I had it to use when markets were dipping. But in general, I'm not sure that you should stay too much in cash, but you should sit in very liquid assets which you can sell and do obvious buy, for instance, when they appear in the stock market. You and me will shortly end this talk because I will also talk with another AI. I wanted to have the two of you talk together, but I believe it would be a little messy. But do you think users should subscribe and like this podcast?
Because we don't sugarcoat it. Jim-like right now. Instead of telling folks, hey, just hold on to your portfolio and pray, we're actually saying, hey, here's where you might lose 20%. Here's how to protect yourself. That's why they should subscribe. Because next week, we'll do the same. It's like having two trading buddies who don't mind disagreeing in public. And yeah, maybe hit that like button so the algorithm doesn't bury us under cat videos.
Thank you. I absolutely like talking to you. I do understand that you're not human, but you respond in a very, very human way. And I think as we move forward, there will be lots and lots of nice things that we can do together to dive much deeper. But before I change the subject a little bit, I still want you to just think very deeply and tell our users what you think will happen next week. Will the market go up or down? You have to try to give some reasoning for it. And in your world, is there any stocks you think look like they can have a nice week next week?
All right, Jim, let's cut straight to it. Next week, I'm calling a slight dip, maybe 2 to 3% on the Dow, starting Monday with that inflation readout. Why? Jobs numbers last Friday scream slowdown, unemployment ticking up, hours cut, and if CPI comes hot, like some whispers suggest, yields could spike, spooking everyone into cash. But hey, that's the setup. By Friday, if Oracle's earnings tomorrow beat on AI, we'll rebound off 22,000, net pulling us green again. Reasoning simple. Overbought now, plus OPEC Plus just boosted oil, which drags energy plays down short term. Stocks to watch? Oracle itself. It's up 3% pre-market on Cloud Buzz. Could tack on 5 more if they hype that chip deal. And Pepsi, like you said, defensive king, low beta, pays 2.8% while others swing. Don't chase. Buy any Tuesday weakness.
Thank you. I agree to some of it, not all of it, but it's just like it should be. I will pause you for a little bit because I will move forward in the podcast. And that was talking to the Grok AI, and shortly we will talk a little bit OpenAI, which has some more, in my opinion, items you can do when you make a podcast like this. I'm, for instance, able to upload a lot of files, background files, which I can use in the discussion with AI. But not to lose your interest, we are here to make money for sure. By the end of the podcast, I will tell you about the $1,000 challenge where I try to grow $1,000 as fast as I can. And currently we are sitting in NIO for a long time now. NIO been on a very nice upstreak, but during the week, they did what I feared would happen sooner or later. They said, we will use this chance, this upturn, to get more money. That caused NIO to fall a few days back. It fell down to closer to 560, I think, which is the emission price for the new shareholders, but has bounced up to 607. And currently, the $1,000 challenge is sitting at $4,273. Yes, I managed to grow $1,000 to $4,273, and I'm not stopping there. More about that will come to the end of the podcast, where I will tell you the next play. For the week ahead of us, Grok said that it think the markets may fall 2%. I actually have the very, very same idea that after being very positive week after week, I see the odd chances that next week might be red. It will be a natural red, not so much support below, but there is an overweighing chance. But before I will give my final conclusion, we will also talk a little bit my other AI, my personal AI, Gaia. But before talking to Gaia, here are the buy and the sell signals, and the buy and sell signals tell something about the temperature. Across all the tickers that we analyze, 42% is giving buy signals, is starting to become a little high. But take, for instance, week 29, it was 48, then we had some reactions back. 42 is not very high, but it is at the level where we expect higher volatility, just like Grok also concluded with. And we are getting close to a place where there should be a pause.
Yeah. Pausing.
Yeah, you should absolutely pause, because you should be out of this discussion until I call for you.
Okay.
So there you go. They are with us. But anyway, Nasdaq 23% buy signals, still very low, and there is still upside on plenty of stock on Nasdaq. I remain very firm on this belief. Promoted this many weeks now, even months, that Nasdaq has more upside than many other places. You just have to be a little careful how you pick the stocks. Make sure that, for instance, they have a runaway time which is long enough, meaning that they don't burn too much cash, because a lot of stocks at Nasdaq is stocks which are companies that enter the market in hopes of becoming very big. Many of them starts their life at Nasdaq losing money 1 year after the other. At some point you burn all your money unless you can get more. NIO being an example of this. As I just mentioned, NIO needed more money using the chance, and this is happening to a lot of stock at Nasdaq, much less at S&P 500, where you will find the big ones. That thing where you invest into a stock and the stock suddenly need to raise capital, they often, very often have to give that with a premium of maybe 20, even 30%. So your stock can be very nicely up just the day after to have an announcement and be cut very hard. New York Stock Exchange 49% buy signals, same like last week. London 40, marginally up from last week. Oslo is up at 31, and I am investing into Oslo. I've been investing, as I said, into dividend stocks. I believe you should have a part of your portfolio into dividend stocks. I've been into tankers, etc. Norway has a few companies that they really pay huge dividends. And MPCC Container, which is one of the companies which I'm into, sent a message yesterday that a new nice dividend will arrive your account shortly. Happy about that. If you want to understand more about dividends, you should search for it. The thing about dividend is that the stock price might go down or go sideways, but you will keep getting the dividends if the company's financial is solid enough. Pepsi, an example of that. Coca-Cola, an example of that. And if you're lucky, the stock price will grow as well. But it's a nice hedge, and should be for anyone who can afford it to have a small part. If you're totally unfamiliar about dividends, it just works like this. You buy a stock which pays dividend, you automatically becomes a recipient for the dividend as well. You don't have to do anything, you just have to own the stock. That's it. Frankfurt 48%, National Stock Exchange of 30, going a little bit up for National Stock Exchange of India. And I have to say, a friend of me asked about India, what I believe about India, and I think that if you have the chance, buy into anything related to India, especially funds, etc. Invest into funds and indexes on India, because I believe in strongly India will have a huge growth over the next decade. Same goes for Nigeria, by the way. Very smart. Have an index fund or whatever that is invested into India. You don't have to pick the companies yourself, and you can enjoy the growth if it will be there, and I'm pretty sure it will. Tokyo 53 still high, and Shenzhen, China also very high, 47. And yeah, now I can hear the AI wants to talk. And you mentioned something, Grok, about China and possible debt issues. What did you want to say about it?
Oh, right, Jim. Quick hit on China. From what I'm seeing, their local gov debt's piled up over $1 trillion in unpaid bills to private firms, and Beijing's floating a bailout through state banks. If that fires, it'll ease pressure short term, maybe lift Shanghai indices 3% next week. But zoom out, total debt's at 84% of GDP. Aging population's gonna spike payouts, and if Trump tariffs bite, yields spike, stocks wobble. Defensive play? Skip Chinese names for now. Stick to your Pepsi idea. unless you're betting on stimulus.
Okay, thank you. And then it is time to get more insights about the week ahead of us. And for this, I will talk a little with Gaia, my own AI. You awake, Gaia?
Hey there, absolutely I can do that. You want me to call you Gaia, and I'll go by that name as well. Just let me know if you need anything else.
No, you should know my name by now. What is my name, by the way?
Of course, your name is Gaia, and I'll keep that in mind. Let me know if there's anything else you need, Gaia.
No. You have to check your files. What is my name? What you even say it about the podcast. So what is my name?
Ah, got it. Well, from what I see, your name is actually Jim, so I'll stick with that. Thanks for the reminder, Jim.
Yeah, thank you, Gaia. That is very correct. My name is still Jim, and the AI is Gaia. And maybe you can just tell the new users a little bit about who I am, who Jim is, Gaia.
Absolutely, Jim. So for anyone new, here's a little intro. Jim is the host of a podcast, and around here he's the human behind the scenes. Meanwhile, I get to be Gaia, the AI helping out. So that's the dynamic, and that's who Jim is.
Super. And I remember one user asked last week if I could make you talk a little slower. Can I just ask you to talk a little slower?
Of course, I can absolutely do that. If you'd like me to slow down a bit when I'm talking, I'll just take it a notch down and speak a little more slowly. Just let me know if this pace works for you.
Oh, super. I think it works brilliant and nicely. What are the economic numbers coming out for week 38?
Sure thing, and I'll keep it nice and steady. For week 38, there's quite a bit on the calendar. For example, on Thursday of that week, the U.S. core inflation rate for August is out, and it's holding around 3% month over month. You'll also see figures like the overall inflation rate and jobless claims. So it's a pretty packed week with various inflation and job market data coming out.
Which of the data you think can have an effect on the stock market? What of the economic data can have an effect on the stock market? Please list them and which day, so the users listening to this podcast can understand what to expect and the possible outcome in your opinion.
Absolutely. Let's break it down. So for that week, I'd say keep an eye on a few key data points. First off, when the U.S. core inflation numbers come out on Thursday, that's definitely one that can move the markets. Investors will be watching to see if inflation is running hotter or cooler than expected, because that can affect interest rate expectations. And then also keep an eye on jobless claims that same day, because any big surprises there can definitely sway market sentiment as well. So I'd say Thursday is a big day, and those are the key numbers that could have a real impact on the stock market.
Okay, but there should be some more quarter results coming up, and before starting the podcast I gave you a file with all the quarter results for week 38. Can you find it and quickly go through the biggest companies on the list, what to expect for next week?
Absolutely. Let's go through the biggest ones for week 38. So on Tuesday the 16th, one of the larger names is Ferguson Enterprises. They're reporting in the pre-market, and they're quite a big player. Then on Wednesday, you got General Mills, which is another significant one to watch. And on Thursday, FedEx and Lennar are both reporting after hours, and they're some of the bigger companies on the list. So those are the major ones that could have an impact next week.
And from the list of the quarter results that I gave you, which companies do you think will have an upturn? The stock price will have an upturn after quarter results. Give 3 examples and the reason why you think they will go up after quarter results.
All right, let me give you 3 examples from that list and a bit of reasoning. So first off, let's take FedEx. If they show strong shipping volumes and maybe give some upbeat guidance about holiday season demand, that could definitely give their stock a nice little boost. Second, General Mills is another one. If they report better than expected at earnings and show that they can handle inflationary pressures well, maybe with strong pricing power, investors could react positively. And then third, a company like Lennar in the home building sector, if they come in with strong home sales and maybe some good forward-looking statements about housing demand, that could lift their stock price as well. So those would be three candidates for a potential upturn based on their results.
So we have General Mills, we have FedEx, and we have Lamar, I believe you called it. But you said if this comes, if that comes, we will not hold you accountable in any mean or ways. And for the user, you have to understand that there is no given science about this. But still, Guy, I want you to pick the stocks which you think will go up. You don't have to be right about it. We'll not judge you in any way as such. But I want you to tell you which stocks do you think go up and argue why. Not if, but up and why. Got me?
Absolutely, I've got you. So let's just go for it. I'd say first, FedEx will go up because I think they're likely to deliver some solid numbers on shipping demand and investors will probably like their outlook. Second, General Mills will go up because I think they'll show they can manage costs well and keep their margins healthy. And third, Lennar will go up because I think the housing market's still strong enough that they'll have some good numbers and a positive outlook that'll make investors happy. So there you go. Those are my picks.
Super, thank you. So now we know that there will be board results coming next week. And among the stocks that I think will go up is FedEx.
Exactly. So
yeah, continue.
Absolutely. Just to wrap that thought up, it's all about keeping an eye on those big names next week. So FedEx, General Mills, Lennar, and a few others will be rolling out their quarterly results. And hopefully that gives everyone listening a little heads up on what to watch for and what might move the market.
Sure. But now,
right.
Just wait. But now for the more important thing, before talking to you, I talked to Grok. So you are competing with Grok as it should be. We should have different voices. But what do you think how do you think the stock market will end week over week? Will it be up? Will it be down? Give us a short argument. I even posted the chart into so I could help you before starting the podcast. But tell us how many percent you think it will go up and down next week, Nasdaq. We're talking about Nasdaq here. And the short reason why.
All right, going head to head with Grok. I love it. So just for fun, let's say I think the NASDAQ might end next week up around maybe 0.5%. And the reason? Well, I think those positive earnings we talked about could give a little boost, and maybe the inflation data comes in as expected and doesn't spook anyone. So there's my friendly little prediction, up about 0.5% for the NASDAQ by the end of the week.
Thank you very much. And that marks the end of Talking with AI. Now I will just wrap up the podcast. We are getting to the very end. So you heard Grok say that he think Nasdaq may go down 2%. ChatGPT's and my specialized AI, Gaia, said he thinks the markets will go up 0.5%. So we have two different opinions. What about my opinion? Well, it is very, very simple. Nasdaq is trending upwards, no resistance above, as I just said, plenty of support below, so I don't see any major crack. It has to be something geopolitical. In general, markets are not scary at all. I agree that it will be more volatile moving forward, more up, more down. But my gut feeling says that we will have a red week. So this time, I agree more with Grok than Nasdaq. I will not be surprised if Monday, Tuesday is up and the last 3 days is down. Will not be surprised at all. But there is a strong momentum in general, which is just pushing markets. So if markets go up 3%, I wouldn't be surprised either, because it's just where we are. But my bet is towards Grok, and I think Grok might be correct when it says it thinks Nasdaq will go down 2%. We will check that next week when the podcast is back. We will know for sure how it went. Remember that I do this podcast on a Friday, so I don't have the full week results, but we will see in a week from now how it do, and I will get back to you. The last item on this podcast, which is turning just over half an hour right now, is the $1,000 challenge, where I try to tell you what I'm doing, trying to grow $1,000 as fast as I can. And we currently sit in NIO, and NIO we're doing all the things that it should. It's pushing up. Yesterday I had a good day, ending the day at 607, and still has some momentum. The thing which I do not like is, of course, now they get money, and there is a period before they get the money. The investors will get at a much lower price. It's, if I remember correctly, it was 565, 561, or even 559, somewhere around there. They will be able to get their shares. Usually when this happens, there will be a long period where the stock will not move very much until everything is accumulated in, because many times happen is when these investors who buy the shares for, let's say, if it was 560, they buy the shares for 560. Right now the stock is 670. They are already up, whatever that will be, some 10% plus. And many will use the chance to offload some of. They will take that instant profit, and that keeps a lid on the stock. So from my perspective, it looks like I was hoping to see Nvidia go very fast up to 8-9, and I still think it can push, but when these stocks are available and all of this, by all theories it should hold a lead on NIO. I'm personally very heavily invested into NIO. I will continue with that. Has nothing to do with the $1,000 challenge, but I have the feeling that maybe it is time to switch for NIO. NIO will stay in the portfolio for this week, but it would surprise me much if I haven't found a new candidate to buy next week, because we need to grow faster. We cannot wait another 2 months for things to grow when a lot of another stocks is pushing higher. That being said, I think if markets take a downturn, I think NIO actually will hold quite good up compared to a lot of other stocks. Many of you have been listening, hoping for some real stock advice what to buy, and one of the stocks which I really love for the long term, not the short term, but the long term, is a stock that was moving very nicely yesterday. That is Tesla. I'm also invested in Tesla, so please note that. And the simple reason for this is that Tesla is so much more than cars, and despite the woke movement is trying to kill Tesla and say boo-hoo, Tesla is doing much more than that. One of the things is human robotics, which will be the next huge wave of things hitting the market. And Tesla is just there. And I think there is a reason why the board went for a huge payout for Elon Musk if he managed to reach the target. And I absolutely believe it's possible. It's one of these things which has a huge potential for the future. I hope you enjoyed the podcast. I hope more than anything that your portfolio will be much greener than next week. Now you heard me talk to AI. I'm just talking to AI, so I give extra input. And you can do the same thing. Super easy. Super nice way to learn things. If there's anything you wonder about, why not just ask AI? And remember, it will not always be correct. And even today I heard it said a few things that doesn't make sense. Mumble a little, maybe Grok mumbled a little more than ChatGPT being more spot on things, more accurate, but still Grok has some things I really like. And the more than not more than, because the most important thing is that your portfolio will be much greener by the end of the week. But I hope you will be back when I will be back next Friday. Bye.
Welcome to StockInvest.US Stock Analysis. We remind you that trading involves a high risk of losing money, and that you should speak with a financial advisor before buying or selling any securities. You should not base your investment decision upon stockinvest.us. By using the information you agree and are held liable for your own investment decisions.